Hello, this is Binoy Tamang with M5 Funding. Welcome to the Art of Commercial Mortgages for Residential LOs. We have just about a minute, if you don't mind. We're just going to wait for a few more people to join us, and then we'll start. Thank you. We're excited to have you here with us. We will wait one more minute. Thank you.
Thank you very much, Binoy. Thanks, everybody, for attending today. And it's exciting to see who's here with us. We've got good numbers here, and appreciate your responses and participation. Sorry about the little technical glitch at the beginning. We had a little delay getting the microphone to work properly. So just a quick minute, I'd like to give you a little background about how I started in commercial, because I think especially for those of you who are either residential or both, and we didn't have anybody respond to the poll saying they're commercial only. So everybody is probably residentially oriented, and maybe a few of you do a little bit of commercial. I started 100% as a residential loan officer back in the day, and this was quite some time ago. I guess I'm giving away my age a little bit here to say I was in the business in the late 80s and early 90s, and ended up growing a pretty good-sized residential mortgage banking company. We had our own warehouse lines. We had our own underwriting and funding capacity. We sold loans in bulk pools and grew that company to do business in 17 states, and then eventually sold that to a large bank, bought us out to put us into their securitization so that they could round out their geographic balance in securitizations, and that was a good sale for me. Was able to exit the business and get a pretty good seven-figure payday, but then was required to stay on with that company for a few years. And I signed a non-compete with that company. Couldn't go back into the residential business after I exited. And my wife has often joked with me that I'm only good at two things. Plunging toilets whenever something happens in our household. I'm the one that has to fix that. And the second thing is I'm wicked good at loans, and I don't seem to be good at anything else. So I couldn't figure out what to do with my life after getting out of the residential business. And so I ended up getting started in the commercial lending business, and actually was lucky enough, fortunate enough to find a very good mentor. Did a lot of crashing and burning in the early days. If you've tried commercial loans and it's not your forte, I'm sure you probably know exactly what I'm talking about. But over a process of several years, really, and I think probably this describes a lot of people on this call, because you almost have to be this way to be in the industry. I'm pretty scrappy. Was able to get some deals done and started to get more deals done, and eventually I grew a commercial mortgage company, turned that into a mortgage banker as well. We were able to do a couple $100 million a year worth of volume throughout the United States, all 50 states. Then back in 2008, when there was a major market meltdown and the CMBS market just disappeared, commercial mortgage-backed securities market, couldn't find anybody to buy the loans anymore, and took a little break from the business, went into the banking side after a little while, as well as owned an accounting firm. But anyway, long and the short is that I'm really a residential guy in the beginning at heart, and had to make the transition. And I think my message to you is that it's not impossible to do. Matter of fact, it's very practical to do. And I think that the most successful loan officer of the future is going to be equally comfortable doing commercial as they are with residential. I think that there's a lot of crossover. You can do business with a lot of the same clients. As a matter of fact, every single day, we get numerous calls from residential mortgage loan officers that have commercial clients that either they've stumbled into or the clients have stumbled into them, but one way or the other, it's a lot of times the same clientele that they're doing residential with. And so the two are very, very complementary, but you can make the transition from residential to doing both residential and commercial, or even to purely commercial, and especially if you're able to find some good help in that regard. So I'd like to talk about why the commercial lending business is such a great opportunity in today's market. So first off, there isn't a lot in the way of regulation, licensing, etc. Let me back up. just some stats here. So according to the MBA, 2015 commercial loan volume is projected at $289 billion, and commercial mortgage debt stands at $2.5 trillion. So that's a lot of commercial loans out there, and frankly, very, very little in the way of competition. During the year of 2013, $238.4 billion worth of commercial mortgages matured. One of the things that's interesting about commercial is that most deals are written with a balloon or a maturity date. Most of them are not fully amortized. A very, very small percentage of them are fully amortized. So just the fact that those maturities are coming up every several years on these notes means that there's lots and lots of opportunity to do business. And there are relatively few people competing for that business. So anyway, back to what I was discussing before, there's very little regulation in terms of commercial lending. There's, and now I want to just, a quick disclaimer, I'm not an attorney. I'm not practicing law here. I'm just going to share with you what I operate with on a day-to-day basis from a practical standpoint, and that is that most states do not have any regulation or licensing. In fact, I think there's only about 10 that there's even a question mark, and even those is up to interpretation. And one lesson I've learned in this business is it doesn't really matter what the regulations say necessarily as much as it matters what the lender's legal counsel interprets the regulations to say, and many of them do not feel you need licensing in any state for any reason. So there's no licensing or regulation, there's no RESPA, no TIL, no other types of disclosures. You're actually able to be paid without that being disclosed. You're able to pay anybody you want without disclosing it. You can pay referral fees without any services being performed. There's no rules on the amount of compensation that you can be paid. It's a very kind of a Wild West, open market compared to the residential lending industry, and it makes it so that there's a lot of opportunities, and you can really do business without borders. So, so what this means, like I mentioned, referral fees are allowable and do not need to be disclosed. Since there's no disclosure of premiums or yield spread to borrowers, you can make significant money on these transactions. Of course, with commercial, loan sizes do tend to be bigger. It's just a function of the sizes of the properties that we're financing. You can do business in multi-states and even internationally in many cases. From where you sit, we're doing business at M5 all over the country, and have even had requests, international requests, and I haven't stepped outside of my office in Utah except for to go to the NAMB conference a couple of months ago. So there's a lot of variety in this business. There's so many different property types. It's interesting every day. No two deals are alike. And even outside of just real estate lending, there's also equipment financing, factoring, and a lot of other areas of commercial finance that are booming as well. So the size of the opportunity is massive, and the limitations on who can participate are pretty much non-existent. So it makes for a tremendous confluence of factors to create a great opportunity here. Okay, I thought that what might be most valuable to most of the people listening today is to go through a number of different actual commercial deal scenarios. These are all deals that we've either recently closed or are approved and are ready to close. So this will give you an idea what kinds of transactions are possible and see the variety that's there. Okay, this is the Westerner is a Western bar in Salt Lake City, and this was an interesting transaction. It was turned down by a whole bunch of other banks and lenders before it came to me. And one of the reasons that banks turn deals down, believe it or not, is a lot of them have what they call a morality clause. And this bar happens to have a bikini bull ride each night that they're open at midnight, and that offended the sensibilities of some of the bankers that looked at it. And I ended up having this deal referred to me. And, hey, The deal cash flows very well. It was an interesting transaction in a lot of ways. Actually, had a pretty weak history initially. A son inherited this business from his father. He took over. It was operating in the red. They were behind and were having to pay out, for various types of taxes and so forth that had accumulated that were delinquent. But the son was a good operator, very, very savvy. He was able to take the thing over and turn it around, and we were just at the far enough into the turnaround to see that that turnaround was working, that revenues had risen, that the property could support the debt. We did a $1.86 million loan on this thing. It went through the SBA 7A program. This is just an owner-operated Western bar, and the broker got paid very, very well for bringing me this deal. Very, very well. Check was in the neighborhood of $28,000. So it gives you an idea what can happen with just a very kind of an odd type of a property. Okay. All right. This was a pretty interesting transaction, just in that the insurance agency that occupied this little old bank building, it was a former bank building, they had a lease option on the property, and they had been paying rent for the last several years and were getting a rent credit for their down payment. So when they came to us to purchase, able to see those rent credits. Now, I know from what I'm told that it's been some years since I've been involved in residential lending, but if I understand that if somebody is paying rent on a lease option, you can only allow a credit of the rent if it's in excess of the fair market rent. Now, in this case, these guys were getting a rent level on this property that they were occupying here at less than fair market value in total, and yet they had a rent credit contractually. Well, with commercial, you don't really have that limitation. We were able to apply 100% of that rent credit. They did not have to come in with any money as a down payment to purchase the property. Their new payment after the purchase was lower than the payments that they were making in rent. So it was a win-win deal for everybody, just an owner-occupied insurance agency situation. Again, the broker got paid very, very well on this deal. This is a very garden variety deal. You run into these all over the place. Matter of fact, one of my favorite questions to ask, and I would recommend that you ask anytime you have a self-employed borrower or a business owner as a borrower on your residential side, is just simply say, do you own or rent your business premises? And just asking that question can turn into a whole bunch of deals. If they do happen to own, it could be a refinance situation. If they're renting, then you know the drill, because you do the same thing when you meet people who are renters who ought to be an owner in terms of residential lending. So you can convert a renter to an owner just by asking a simple question. So anyway, okay. So wanted you to see that there's deals of all sizes and types here. We're going to try to show you a variety. This isn't anywhere near, of course, all the deals, but I wanted to give a variety of different transactions so you can see what's happening. This was an owner-occupied accounting office. This is the quintessential left brain, anal accountant-type personality who was crunching every number. He'd been shopping his refi at every bank in town. We were able to win the transaction over by showing him advantages in terms of rates and terms, and we did some number crunching with him. So he ended up refinancing this thing. This is just a conventional first mortgage refinance. He only needed $390,000, even though the building was worth significantly more, but he was just wanting to refinance exactly what he owed. Matter of fact, he even insisted on paying his closing costs out of pocket so that the note would not increase. He was more focused on getting out of debt as soon as possible and lowering his costs in the process of doing so. So we showed him how a 5-year transaction with a soft prepay would give him the lowest rate, and because of the excess earnings that his business had, he could pay down that loan up to 20% of the original principal balance per year without any kind of a penalty, and that the 5-year rate would be the most advantageous. And he bought it. He went with us, and we completed this refi. couple months ago. But just a typical owner-occupied office building situation there. Okay, now let me show you something else that you may not realize can be financed under commercial lending parameters. This is a kind of an ugly little single-family residence, you know, we actually can do single families in several scenarios for commercial lending. One of them is if it's a rental property, and in most states we do have regulatory approval to be able to finance a single-family rental property as a commercial loan. And the only reason that somebody would go with us on something like that is because we have a stated income program for that. So this was a stated income deal. They didn't have the ability to verify income, but they wanted to do a refi on this rental property, get cash out. We were able to put that together, just collect a 1003, a lease agreement. You get a conditional approval in about 48 hours, and then collect a few more things, get an appraisal, and it's a fairly simple but not necessarily quick process. But just wanted you to see that you can even do single family. Now, by the way, just as an aside, the other scenario in which we can do single family or 1 to 4 unit properties under a commercial program is if we're doing portfolios of those kinds of properties. So as long as we have a minimum of 5 doors and $500,000, we can do a bunch of single families as a portfolio. They don't have to be near each other. They can be in different states. They can be in different towns. So we can take a handful or a dozen or 100 or 500 single families, duplexes, triplexes, fourplexes, a mix of all the above, and we can finance them as a portfolio. And as a matter of fact, that's a really common loan scenario these days. There's been a lot of people accumulating these kinds of properties, and then they can't finance any more purchases on conventional loans because, as you well know, because you're the ones referring me these deals, they run into a limit as to how many properties they can finance on a conventional loan. So what they do is they take all those, they put them into a portfolio, and they clear out that bucket, so to speak, so now they can go out and finance more conventional mortgages to acquire more properties. So we put them into these portfolios, and we're able to do this even on a non-recourse basis, by the way, meaning that there's no personal guarantee required on the loan, so that even IRAs and pension funds and so forth can own portfolios of these properties. I just wanted to mention that because I thought that might be kind of interesting. Okay.
May I interrupt? Looks like we're having some sound problems. Everyone, we're going to try and see if we can just reset the microphone. If you can hold on 1 second, please.
The fun of technical difficulties. We'll be right back with you. Okay, I hope we're back. I hope the sound's working okay. If you wouldn't mind, if we are having an issue, just put something in on the question panel and we'll be able to see that. But we had a couple of folks let us know that we had a sound issue, so apologize for the brief gap there. Okay, we're going to skip past this next slide because it's another single family. It's a purchase situation in this case, but just to know that you can do single families, duplexes, triplexes, fourplexes on a commercial loan program if they're non-owner occupied, and the reason to do that is for the stated income feature. So, okay, this is just a corporate office type situation, an office condo. What we had here is a client that came that was operating an IT business. Very, very profitable business. They owned their building. They needed to expand. There was another office condo right next door to the one that they were operating in. They decided to, initially they thought they were going to move into it. Then they decided they wanted to just keep the one they were in and buy the additional one. We initially got them approved on an SBA 504 loan at 90% LTV to be able to do that. And for whatever reasons at the last minute, the borrowers decided that they didn't want to go SBA, and they said that they'd had some experiences with SBA before. They weren't really keen on SBA for whatever reasons, and frankly, that's really exceptional because most clients love the SBA product when they have it. But anyway, they just changed their mind. We did a very quick reversal at the end of the deal. We ended up doing a refinance on their existing office condo. We used the cash they pulled out of that as the down payment, did the financing for the purchase of the condo next door. Instead of going 90% LTV on an SBA, we did conventional at 75 LTV. The rates and terms were absolutely fantastic. These people loved us, and again, we got this from a broker who got paid well, and we've since received referrals from this same client of other clients, and you know, just a successful transaction, just an owner-occupied expansion situation. Okay. All right, so our next transaction, this is a multifamily apartment building, and this was initially given to me from a banker, a referral from another lender, and there's a lot of reasons, and we're going to get into this a little bit later, why lenders will refer a perfectly good deal to you. So one thing I want to bust is the myth that bankers and other lenders will only refer you bad quality deals. Absolutely untrue. In fact, my best quality deals come from other lenders. They turn deals down for a variety of reasons that are very, very good that just don't fit their box. We're going to go into that in more detail in a minute. I think those reasons will be very valuable to you because they can help you go get business from these folks. But this is a $4 million cash out refinance. These borrowers have owned this property for about 10 years. Interesting thing about this deal is that the partner that was referred to me on this deal owns the property 50-50 with another very well-heeled partner who owns a number of other properties. And partway through working on this transaction, that second partner actually brought me another deal, which I think you're going to see here in a few minutes. And since that time has brought me 3 more transactions. And this is just an example of how this business can work when you're out there and you're doing a good job and you're providing good solid rates and terms and you know the process, so there's not a lot of wrinkles. You get it done without, you know, problems and issues. You get a lot of referral business, a lot of repeat business. For that one partner, the one that came to me second as a result of this referral, I've ended up doing, you know, an additional $8 million worth of transactions just in the last few months. And as you can imagine, there's a lot of value there. So you can really generate some serious revenue in this business in a very short period of time. Okay, next deal, wanted to let you see, and this is just a good example of the range of quality of properties because obviously the multifamily loan was a high quality building. You look at this thing, this is obviously not a high quality building. It's a metal building. It's old. The interior was in serious disrepair, but this was an SBA 504 owner-occupied situation. A good real estate broker, source of mine, referred me this client. It was his buyer, and able to get him approved on a 90% LTV to purchase this. These guys have an interesting business. They actually buy and then resell used shoes. And when I say buy, they get a lot of them via donations. But they do purchase them from places like, you know, Goodwill, and they have schools collecting shoes for drives and so forth. And anyway, it's an interesting business model. They've been doing this for a number of years, and who would have thought you could generate millions of dollars of revenue buying and selling old shoes? But that's exactly what they do. You run into a lot of interesting things in this business. In this case, by the way, there were 2 partners. One of them had really excellent credit. The other one had really, really poor credit. So 50% of the sponsorship of this loan had poor credit. Matter of fact, a no score on 2 of the bureaus. All there was one current account and a whole bunch of collections. We were still able to get this thing approved. And not every lender will do that, of course. Now, the one thing about SBA is not SBA. And the way you structure a deal can have a lot to do with whether it gets done or not. But because the sponsorship was strong on one end, we were able to get an underwriter to look at this as, well, hey, if I had just this guy, I'd do the loan. If I have another guarantor, how does it hurt me? We were able to get the loan done even with some weak sponsorship there. Okay? So, okay, here's the next one. It's a single tenant office building, and you'll see this coming up in a moment here. This is a non-owner occupied single tenant deal, so it's not an owner occupied situation. Again, a pretty interesting transaction in that it's a 1031 exchange situation. So for those of you not familiar, the buyer/borrower had other properties that he sold into a 1031 exchange and had to reinvest the proceeds within a certain set period of time in order to avoid capital gains taxes. So he found this property, single tenant property, did not currently have a tenant in it, but was up for lease. The agent that referred this transaction to me was helping him to lease the property. We thought we'd get it leased prior to him having to close on his purchase loan. That, in fact, did not happen. So we had to close a bridge loan to accommodate this borrower so he could meet his 1031 exchange deadline and not lose out on those tax benefits. And now the great thing about that is, of course, we make money on that deal, and now as soon as he gets a permanent tenant in the property, we're going to go ahead and close the permanent loan we'd already committed on this deal. So this is an example of how one deal can turn into 2 deals, and also how you have to be flexible because you're going down the road on these transactions, and there's just a lot of ways that things can twist and turn on you, but you have to, be scrappy and figure out how to get it done to accommodate your clients. But good quality office building, super project, and a really strong borrower, $925,000 loan amount. And just as an FYI, by the way, I just want to mention that we actually, in some states, we do pay real estate brokers for bringing us transactions. They are able to verify for their own benefit that there isn't any reg against doing that in their particular locality, that they can actually be paid on a real estate transaction and a loan transaction at the same time. Other commercial brokers don't want that. They simply want us to help them close their deals so they can get paid. But I just thought it might be interesting for you to know that there are some real estate brokers in the commercial arena that do get paid, and it is perfectly legal in some cases, although, again, quick disclaimer, not a lawyer here, okay? All right. Our next transaction is a student housing project in a tertiary market. And what's interesting about a deal like this is it's in a small market, small population, a little college there. So in case you're not familiar, there are a lot of multifamily lenders that will not make a loan in a market with a population less than 250,000. There's some other lenders that won't go below 150,000 or 100,000. It's actually very, very unusual to be able to get a loan done competitively with some type of a program other than a local bank in a little teeny tertiary market. And it's even more unusual to do that on a student property. With multifamily, there's a lot of different property categories. You've got student projects. You've got subsidized projects where they have Section 8 or other subsidized rents. You've got furnished versus unfurnished units. You've got studio or efficiency units versus regular market units. There's a whole bunch of different factors that would make a project qualify under one program and not another, or not qualify. And it's a really interesting marketplace. But anyway, able to get this deal done. Matter of fact, I'm celebrating because I just funded this one yesterday, and that was a great deal. That was referred by a banker. So and this is the one I mentioned. This is one of the ones that the partner of that original multifamily project I showed you that we did a refi on. This is that partner purchasing this project who engaged me partway through that refinance, said, hey, can you help me on this one too? So this is how deals lead to deals. Things can snowball a little bit. Okay, now to the extreme here, I wanted to show you this next deal. It's a little office trailer and a little old, pretty dilapidated looking warehouse. And this is only a $100,000 loan, and if you look at the property, I think you'll be able to appreciate why, because the property's not worth much more than that. But that's one of those modular offices there. These guys are a little cement manufacturing company or something like that. And I think I'm crossing deals here. I apologize. But anyway, this was a non-owner OC. The owner just owns this as a rental property. This was a cash-out refi. The property was free and clear at the time. We did this on a stated income basis. A broker brought us this deal. Broker was paid. But I just wanted you to see some of the extremes. When we talk about commercial lending, it doesn't always mean the big, beautiful trophy properties. I mean, right now, I don't have it up here because we don't have it approved yet, but I'm working on a $15.5 million refinance of a beautiful Class A medical office. And, we're competing against the likes of Wells and other big banks, and we're beating them by 40 basis points because we're able to get money from life companies and so forth that the banks just can't compete with those cost of funds. So you get everything from that extreme of high quality to something like this. So there's never a dull moment in this business, and you can do or not do the little deals, but I recommend doing them because deals lead to deals. So this is another example of that type of thing coming up next. This next property, this is actually, there's a single family home and an old shop on this commercial lot. It's commercially zoned. It's like an 1.5 acre lot. This was purchased by a landscaping company that wanted to occupy this to operate their business, use the shop and then use the house as offices and for storage and supplies and so forth. They bought this thing with the intention also, we included about $90,000 of renovation rehab money because they needed to fix some things and add some fencing and do some paving and so forth. So, a deal like this is based almost completely on just the cash flow and credit of the owner occupant. You can do almost any kind of property when it comes to this type of SBA financing, even an old commercially zoned house like this with an old dilapidated shop. So you got that. You've got about anything. Special purpose properties, hotels, gas stations, et cetera, et cetera. So, okay. Now we've got another one we're going to show you here. This is a deal that has a salon, beauty salon on the main floor and an apartment in the basement. And it just so happens that the owner of the property occupies the residential portion and leases out that salon space. Well, about 6 banks turned this down. He was everywhere, and they couldn't do the deal because it was owner occupied. And they said, well, that kind of crosses the line between residential and commercial. You're occupying this as a resident, and yet obviously this doesn't fit residential programs. This guy was kind of caught between a rock and a hard place. Because of that, we were able to get it done on a stated income program, and this deal is currently approved and getting ready to close. So just another example. This again was referred by a broker. As you probably noticed, a lot of our deals are. So again, a good variety of different transactions. And the reason this went stated isn't really because he needed to go stated. It's because it was the only program where we could do this occupancy situation, so we took it stated anyway, even though this particular borrower had plenty of income and so forth. This is just a regular little old cash-out refi on some apartments. And they were also doing it to lower their rate, but they needed about $100,000 cash out to do some roof repairs and so forth. And good, strong borrowers turned out to only be about a 50% LTV. We got the deal, frankly, just because our rates and terms were superior to everybody else they were shopping. That's really the bottom line. It was they were currently at about 7% before they refinanced, and they're at 4.2 now on a 7-year fix with a 30-year AM. They're very, very happy people. And that was actually a direct borrower that was referred to us. Actually, you probably noticed most of these deals that we've shown you are either from a broker or a banker. This is another broker deal, just a small little sixplex. They had to close really, really quick. They had when the deal came to us, it was a very, very short fuse on their REPC, and the borrowers happened to have enough cash to go ahead and just pay cash for the property. And about a week after they paid cash, we did a refi, got them 75% LTV, back cash in their hands, so that they were, able to have some leverage on the deal. So delayed purchase transaction, treated like a purchase even though it was a refinance. Good little transaction there. And this is an owner-occupied office warehouse. This is an electrical contractor, very profitable business. They'd been renting. When somebody's renting and they want to move into their own premises, in this type of a business, it doesn't really matter where they move because their customers don't come to them, so to speak. If you're doing the same thing and it's a restaurant or a retail store and somebody's moving, 10 miles down the street, or a gym and they're moving 10, 15 miles down, you're going to have some troubles with that because, of course, the first question on our minds and the underwriter's mind is, well, are the people going to move with them? Are their customers going to move with them? But in a case like this, it really didn't matter at all. They could put the business wherever they wanted it. It qualifies based on the business's revenue, and they had great revenue history. This is a conventional purchase. They put a lot down, and just a simple deal from a broker again. All right. This is just a small SFR purchase. I'm just going to skip past this because we're starting to run short on time. I'm going to get to some how-tos and some details for you right now. The first thing that you got to decide if you're going to get involved in this business is whether you want to be a specialist or a generalist. And there really are advantages and disadvantages to both. I've actually done both in my career. At one point, I owned a company called National Apartment Finance. So you can't get much more specialized than that. All we did was apartment buildings, and I did hundreds of those during those years, and we did them all over the country. And that was a great business, but I was constantly turning down transactions of other types because the very same borrowers that were coming to us with those apartment buildings owned other properties, were requesting other things, and we started doing other things. I tell you this, one of the things I've realized is, especially when you're starting out, it really does pay to be a generalist as long as, and this is a big as long as, you have somebody to go to help you to size and price and qualify the deals, because it can be a little overwhelming at first if you're trying to do a whole bunch of different types of loans in the beginning, because these are all very different from each other. The Fannie Mae multifamily program or Freddie Mac multifamily program, those are way, way different in concept and design and underwriting than an SBA 7A versus an SBA 504, versus just conventional term lending, versus the non-recourse types of programs, construction versus perm, very, very different. The different property types, special use properties, general use properties, they all have their own lexicon of vocabulary and issues. Hotels have their own particular issues. You're dealing with things like RevPAR and occupancy rates, daily room averages, and so forth. I mean, they're just metrics that come into play on certain property types that you don't get on other property types. And different underwriters specialize in different ones of these. I think what I have learned is that when you cast a broad net, you get a lot of deals. You just better be good at sorting out and getting them done, or you're going to choke on them. But as a broker starting out, you're going to find a lot more success more quickly that way. And this is one of the important reasons for that, is capitalizing on the banking gaps. If you go to a bank and say, give me your turndowns, but the only thing I want is your multifamily loans, you're probably not going to see that much. You'll have to cast a really, really wide net to get enough of those. But if you go to a bank and say, hey, I want you to give me all your turndowns, and we can handle about anything that you're going to turn down, you're going to get a lot of referrals out of any one banker. You don't need a lot of those relationships. So we're going to talk about the reasons that banks turn down perfectly good loans right now. One is what they call portfolio concentration. I just went to lunch with a banker yesterday, says our bucket's almost full on hospitality. So he's talking about hotel, motel, bed and breakfast. He says, we maybe got room for one more and we're done. And what he means by that is that the regulators require them to balance their portfolios between different types of loans and different property types. And if they have too much of one thing, they're out of compliance, and then they get censured and they get penalties and so forth. And so portfolio concentration, I mean, a bank can turn down a beautiful loan just because they can't take any more of that type of loan on at the moment due to portfolio concentration issues. Lending policy limits. I worked for a bank, brought them in a 12-unit multifamily, 50% LTV, really nice property, newer, cash flowed well. They said no. Why? Because they would not allow for that type of property in their lending policy. They have a written lending policy, and they have to publish it and renew it each year. It has to be approved by the loan committee and by the board of directors, and if it's not in there, they generally can't do it. And banks have different experience levels and different areas of expertise, and so some banks just do all of one thing. That bank, I was working for the bank as an employee at the time, all they wanted was SBA 7A loans, period. If anything else came in, it could be the best deal in the world. They wouldn't do it. Matter of fact, they had a thing about sporting goods businesses. They wouldn't do something like that because they had a bad experience with sporting goods businesses. If I would have brought them Nike, they would have turned it down. Wouldn't have mattered, you know. And that's what I'm talking about here when we say committee biases. They have some kind of an experience. It's not a rational response. They just get emotional about these things, and they just start saying no to things that make sense because they've had some kind of I touched the hot stove and got burned kind of an experience. Okay. Legal lending limits. All these thousands and thousands of community banks all around the country, they have a legal lending limit. All banks do. The big banks, you'd never know it because it's so large it doesn't matter, but all these littler regional and community banks, a lot of them have limits because they can only make a loan of so much or an aggregate of so much to one borrower. A guy comes in, wants a loan for $1 million, they have to say no because their lending limit's $750,000. And they're turning down a good customer, and they don't want to do that. And you can be the hero. We'll talk about that in a minute. Geographic limits, same thing. The small banks have a primary lending territory. It's defined in their lending policy. If you bring them a loan that's outside of their territory, chances are they're going to have to turn that thing down. And those territories can be pretty narrow and pretty limiting from time to time. You'd be really surprised at what banks have to turn down just because of geographic issues. Here's a big one is loan officer and experience. A lot of times the guy sitting behind that desk is a recent college grad. Nothing against recent college grads. But he hasn't done a lot, and someone walks in, and he has to kind of fake it, act like he knows what he's doing when he really doesn't. But because he's inexperienced and doesn't want to admit it, he kind of goes through the motions of taking that loan application, but the thing dies on his desk because he just doesn't have the experience to do that type of loan. This happens all the time. And of course, those are all reasons you can get really good deals referred to you. Now we're going to talk about some of the ones where you might get not so good deals referred, but you know what? In my book, a good deal is anything you can close and get paid on. I don't care if it's high quality. You saw some of those junker properties that we've done. As long as the deal pays, I'm good. So let's talk about the not so good deals, but they're still good in my book. They get turned down for credit reasons, of course. I mentioned that deal where we had a sponsor situation with half the sponsorship having bad credit, half having good. A lot of banks would turn that down, and of course just plain old bad credit, period, from all the sponsorship, that's going to get turned down. A lot of times you can get those deals done. Lack of income is another reason, or lack of income documentation. Well, this is where stated income products come into play, and there's actually quite a lot of that available again in the marketplace, so you can get deals done that the banks don't want to do. And that also dovetails into that the property or the business doesn't cash flow qualify. It doesn't show on paper that it does, and maybe it really does, and there are some telltale signs that it really does. I mean, you got some guy with his, auto repair shop, and the thing is great, and he does a lot of cash business, and his shop is in ship shape, and his bills are paid, but on paper he's losing money. I saw a liquor store deal recently where the borrower on his tax returns showed that his cost of goods sold were higher than his gross revenue. And of course I'm thinking to myself, yeah, right, he's going to actually buy his inventory and sell it for less than he paid for it. But, that's what he was showing, and that was probably his way of avoiding taxes. But a deal like that could be done on a stated basis, hard money basis, or something else. And then again, banks frequently turn deals down because they're special purpose properties. Most banks don't do gas stations. Most banks don't do C-stores. Most banks don't do hotels. A huge percentage of banks won't touch an assisted living or a nursing home, a car wash, an RV park. These are all deals that I've seen and done recently that banks turn down, and you can do them. And so, you can be the banker's best friend by being the good guy and giving them somebody to refer people to so they don't have to say no. When they say no, they're taking big risks of losing those clients' banking relationships, not just that loan. They walk out the door, they go to another bank, the bank does it. They're going to ask for all their accounts and their entire banking relationship. The guy doesn't want that to happen, so your banker is going to want to refer you people. And they're not interested in money for the most part. They just want to help a customer. So here are a couple of the questions that you can ask bankers. What kinds of lending do you do, or what do you not do? And when you go in and sit down with a banker at their desk and talk to them, you'll find it's almost hard to get out of there once you get them talking. They love to visit. They don't have a lot of people calling on them. Ask what their lending territory is, because again, they have limits, especially the little community banks. And by the way, let me not just say banks here, credit unions. A lot of credit unions are into commercial lending these days, and they're just as good of a target as a small community bank or commercial bank. I love asking this next question. Are you a conservative bank? They usually puff up their chests and say, oh yes, we're very, very conservative. Oh yes, we're super conservative. They've just kind of backed themselves into your next question, which would be, you know, hey, what do you not do then? What do you turn down? You know, do you turn some loans down? I mean, you're really conservative. You must turn deals down, and they do. You ask them about their credit requirements specifically. You know, what are your credit requirements? What are your property types you do? What kind of loan to value do you go to? What are your debt coverage or cash flow requirements? What are your documentation requirements? What you're looking for here are gaps, things that they can't do that you can do. And by just sitting down and having this conversation, you can find a lot of those. It's a great thing to do. Take them to lunch and sit there and let them talk for an hour. And here's what I find interesting. When you first walk in and say, you know, hey, do you have any turn downs? I'll usually say no, but by the time a half hour or 45-minute conversation's gone by, they'll say, you know, come to think of it, there was a guy in here yesterday, ... You'll find that they suddenly remember deals. So one thing to ask yourself is this person that you're talking to an active lender? Just because they're sitting at a bank doesn't mean they're active in the business. There's a lot of desk warmers. There's a lot of people that do a loan every 6 months working at banks. There's also guys that are doing a bunch of deals every month, and you want to try to figure that out, who the active lenders are. And it isn't very hard, because as you get talking, you can figure out really quickly by the things that they share with you and their experiences and whatnot, whether they're an active lender. And this is kind of an obvious question, but do you like saying no? If they're turning deals down, do you like saying no? And why not? So those are some of the things that you can ask bankers. There's a lot we could talk about in that regard. Bottom line is you can be their hero. We're not competing with the bank. We don't want the customer's deposits. We don't want the banking relationship. We just want to be a transactional relationship. We just want to do that loan, keep their customer happy, and make them the good guy. And if we have to turn it down at the end of the day, we can be the bad guy for them. It's not them saying, I can't do your loan. It's us saying this loan can't be done. They can stop losing those banking relationships, and they can stop saying no and start saying yes. So in conclusion of our formal part of this presentation, I want to just take you through a 2-minute quick crash course to originating commercial loans. And this is a really simple process. You can start doing this today. You don't need to know a lot about this business. The first thing that you want to do is that you want to get a soft quote from your lender. And you can call whoever your lender is, and you can call us. And again, you need to be pretty broad here, because if you're not dealing with somebody who covers a wide variety of different loan types, you're going to get a lot more no's than yeses when you don't have to. But you just gather some particulars about a deal. Just ask a few questions. I mean, what's the loan amount? What's the property type? What's the credit like? What's the LTV? You know, where's this thing located? What's the purpose of and use of the proceeds? Is this going to be for just a purchase? Is it a cash out refi? What are they doing with the cash? Just basics, things that you would ask on any transaction you might do. You get a soft quote from a lender, meaning, hey, here's some rates and terms, assuming that they meet these other requirements. This is probably about what we could do for them. Or you might even get a couple of different quotes. Hey, it could fit this program here. Here's the rate. Here's the term. Here's the amortization. Here's the cost. Or it may fit this program here if it's not quite good enough for the first program. Here's the rate. Here's the term. Here's the amortization. It gives you ammunition to go back to your borrower so that you can actually get them to provide you an application packet, because a lot of times you need a little bit of ammunition to be able to get them to do that. Now, I will tell you this. I know people that are great enough at charming an application package out of a borrower that they don't even need a soft quote. If that's you, then just tell them, hey, here's what we're going to do. I'm going to collect this information from you. I'm going to run it up the flagpole to my underwriters. I'll get back to you with some quotes and tell you exactly what we can do. And if you can get people to provide you their tax returns, their financial statements, and so forth, a basic application form, without having to give a soft quote, go ahead and skip the first step and just get the packet. But if you need the crutch, if you need to have a little bit more incentive involved, then get a soft quote so that you can use that as a reason to pull a deal through. And I'll tell you, that is powerful. And I say if you need a crutch, I guess I need them from time to time. That $15.5 million deal I told you about a little bit ago, I would not be pulling a package in if I wasn't able to quote them about a 3.8% rate fixed for 15 years with a 25-year AM. They had already had quotes from other banks. I wouldn't have gotten the time of day without giving them at least a soft quote. Now I'm going to be able to put that into a firm LOI shortly, but the soft quote can really help you win deals. And so getting that intel from your lender on the front end can really help. Okay, the next thing you do is after you get the packet, submit it in. Submit it to M5, of course, and we will, within about 3 to 4 business days, generally have a conditional approval and get a letter of interest out to you that you can present to your borrower. The borrower then signs that letter of interest if they want to go forward, and you're pretty much done. It's a pretty simple process to get paid on these deals. We'll guide you through it every step of the way. Okay? And now, have a couple of things I want to give you for attending today. And these are some complimentary things we just want to make available to you. First of all, we recorded this webinar, and we will send a link to the webinar out to you via email so that you can listen to this again and again. You can share it with other people in your office, whatever you want to do. And secondly, this is a really nice bonus. Now, there was a book that I wrote back in about 2005 or 6, and we had a fantastic chapter in that book. I used to sell that for $1,000 a copy. This chapter was on marketing commercial loans. Now, I'm going to send you a free PDF of this this marketing chapter. Now, it's a legacy chapter. I have not gone through. I don't have the time to update it all completely. I want you to know that 95% of it is still accurate, right on the money. I reviewed it. You'll see the way that I and the people at my company have been thinking and working for years to bring in hundreds of millions of dollars worth of commercial loans. All the ways we do it are talked about here, and I think you'll find this really, really invaluable. So we're going to send you a link so that you can get a download of that chapter. Okay, and then last but not least, this is just for the first 10 people that respond after this webinar. We have a free one-on-one session that you can have called Exploding into Commercial. Double, triple, or 10 times your business by transforming yourself into a commercial lending pro while achieving your maximum potential in your residential business. Okay, now what this is, it's a one-on-one session with me. We'll spend about an hour, and we'll create a crystal clear vision for the business that you truly would like to build, including what kind of money you'd like to make with commercial and or residential, and the lifestyle you'd like to achieve with this business. We will look at the challenges that you have, the hidden challenges that are keeping you from reaching your goals and your full potential for both earnings and lifestyle in the business. And this, again, is custom for each person. This is a one-on-one session. We want to look at your skill set, your environment. We want to help you create a strategic action plan. We want to help you to identify the skills you need to build and so forth. And you will leave this session renewed, re-energized, and inspired, and with the ability to reach your goals and potential in this business once and for all. Now, because of limited time, unfortunately, I can only provide sessions to 10 people. I just don't have time to do more than that. If there's more that respond, we might put you into a future month on a waiting list or something like that, or we may not be able to do it. But anyway, wanted to make this available as a thank you for attending. And I turn the time over again to Binoy.
Thank you, Joe. That was fabulous. And just so everyone knows, please type in coaching session into the Q&A portion of the GoToWebinar, and that way we know that you're interested. We wanted to make sure you have that opportunity. Again, type that into the Q&A portion. And we have formally finished the portion of this webinar, but we have lots of questions. You're welcome to stay behind. And I'm going to read out the questions that have been coming in from the Judys and the Mo's of the world so that Joe can answer them. But again, if you'd like to take advantage of that 10-slot coaching with Joe, please type into the questionnaire portion I'm interested in coaching or coaching for me, whatever, please put that down. Thank you. And again, you're welcome to stay on with us. What we're going to now do is spend a few minutes answering some of the questions that have come in. And please feel free to type them in. We'll see how much time we can continue, but we'll try to get as many of these questions down as much as possible. So, Joe, I'm going to just ask some questions, and you're going to answer them if that's okay.
All right, let's do it. Okay. Let's see. And I think Benoit's trying to ask questions that are representative of a lot of folks' questions, hopefully, so that we can help as many of you as we can.
Super. Judy asked this question. She's in California, and she wanted to know, doesn't matter what state she is in, what are the limits and so forth in interacting with M5?
Okay. Well, hey, great question. I appreciate that. And no issues. Doesn't matter where you are. As I mentioned earlier, there's not a lot of regulation. There's no licensing required for most commercial lending activities, and there may be in certain states, like in California, there may be some product-by-product limitations from time to time, but for the most part, we're talking like 95%. We can do anything there that we can do here or anywhere else in the country in terms of what types of commercial loan programs are available.
Is there a minimum loan amount, Joe?
Well, that's program by program. So on these stated commercial loans, you can go as low as you probably saw here in the slideshow, as low as $100,000. I mean, hey, we're not looking to do those all day, and I know you aren't either. But deals do lead to deals, so I'm a big believer in not turning away small deals or being prejudiced on deal size. But on other products, there may be other limits. Like, for example, SBA 7A, you need at least a couple hundred, say $200,000. On 504, you need at least $500,000. On multifamily, it depends on where you are. There's some programs where you can go and do a small $250,000 to $300,000 multifamily deal. In other areas, you really have to have something of $1 million or more to take advantage of the programs available. And some of that is, again, as I mentioned, there's some demographics that drive this stuff. Some lenders are not willing to make a loan in a market where there's less than a certain population within a certain radius. That's not something that's an M5 thing. That's just kind of an industry thing. But again, depends on where you are. But what I would say is don't hesitate to email or send any request or give us a call, because we'll tell you if we can do it. It only takes about 3 minutes on the phone to figure out if there's something there that's possible. So.
Super. A question came from Mo as you were going through the sequence about how to work with M5. He asked, what's in an application packet? What does an application look like?
Well, hey, Mo, thank you. That's a great question. And there are actually, the reason we didn't define it is because that depends on the deal type. So, for example, we collect different things for a multifamily loan than we do for an SBA 504 loan. And we collect different things yet for a term loan on an office building, an investor office property, or an investor-owned retail strip center. So what we do, once we determine what type of program the deal fits into, we send the appropriate checklist and application packet for that deal. But let me just tell you in general, and I think you guys might find this instructive, you can kind of categorize all commercial loans into really two overall broad categories: those that are underwritten to global cash flow and those that are not underwritten to global cash flow. Now, there's a third, and I'm kind of cheating here because the third is a stated income product, but even those are actually underwritten to cash flow. We just don't have to collect documentation to prove the cash flow. But so the global cash flow deals include things like the owner-occupied full doc deals like SBA, or owner-occupied conventional, or any kind of deal that it really can include almost anything, even small balance, tenant-occupied property type loans, term loans. And what we're doing there is we have to look at all the income and all the outgo on a global basis for that borrower, not just the property. And that might include affiliated businesses. If there's multiple borrowers, it includes, their personal income and outgo from them, their spouses, etc., in their households. It's called global because we're looking at all the income and all the outgo, and there's some calculations and spreads that have to be run there. And generally, you're looking at about a 1.2 to 1 coverage. And so, as you can imagine, you've got to collect personal tax returns, business financial statements, personal financial statements. You have credit reports to see what things the borrower has to pay on a personal basis. You have to pull business credit reports and do a business debt schedule to see what the business is paying on, and you're looking at that entire picture. It may sound like a lot. It's actually a lot simpler than it sounds. And then there's the non-global cash flow deals, and those are really underwritten primarily based on the property itself. Not to say that the borrower doesn't matter, because the borrower's experience and net worth do matter, but their cash flow doesn't matter. You're just underwriting the property's cash flow on those deals, and that's really common with the non-recourse loans, like the larger tenant-occupied, quote-unquote, investor commercial properties, larger multifamily, etc. So I hope that helps answer the question. I'm not trying to be overly general on purpose. It's just that it's a pretty elaborate topic.
Thank you. There's a great question from Christopher, and he essentially wants to know, is M5 a broker or a lender? Who pays you? And ultimately, how do you go about this whole sequence, including details like what's a typical sequence look like from start to finish?
Okay.
So it's a lot, but if you can help answer that, Joe.
All right, I'll do my best to remember the whole question there, Chris. So let me just say, I guess you could technically say M5 is a mortgage banker, because we do actually have docs in many programs that are in our name, and so we're closing and funding in our name. But I want to just tell you and everybody on this call, because we're very, very transparent here. We're not trying to be something that we're not or pretend we're something we're not. We don't keep any of those deals longer than the ink dries on the note. I mean, we're really, in essence, a broker. The difference between our core programs and our non-core programs are that on the core programs, we're actually selling those on the secondary market, and we're collecting, some kind of compensation on the back end for that. And so, like I say, I guess you could technically say we're mortgage bankers, but really in reality, we're just a large and very productive brokerage operation. I think the advantages to that are that we actually can get better pricing and get more deals approved than if it were otherwise. And I say that because just based on long experience, I can take the same exact SBA deal to 6 different lenders, and 5 of them will throw up on the deal and 1 will love it. You would think SBA is SBA, and it's not. Same thing is true with other property types and other deal types. And so, and not only that, pricing is not the same everywhere you go. There's a lot of differences in pricing, even on these government programs like SBA or others. And so, there's an advantage, because you're not going to be turning deals down that you otherwise could have gotten done. You can shop for the best pricing, and since the compensation on those core products comes from the secondary market, it's back end, it's premium, and you get paid out of that at no additional charge to the borrower, we're able to be extremely competitive. And what you're paid is not disclosed. So the borrower never sees what you're getting paid. We just 1099 you at the end of the year. We can pay it directly to you, to your entity, to your wife, to your dog who owns an LLC, whatever. We just 1099 it. There's no disclosure. And we found that we've dealt with a lot of brokers over the years. They love that arrangement. Now, we have our non-core products too. Sometimes we're just brokering a deal. Sometimes we're just splitting a fee that we're able to charge in origination with you for bringing us a transaction. That does happen. We have lender relationships where they will waive their normal origination fees so that we are not charging 2 fees to the borrower. They're paying 1 fee. There's cases where we go that way even when we do have a core product that fits, because the borrower is going to get a better deal by going non-core. And I will tell you, it doesn't make sense to try to force the wrong product down a borrower's throat. It's better just to do the right thing by the borrower and give them the best deal you can and make what you can make, because some transactions are small, some are big. Deals lead to deals. If you follow that philosophy, you close a lot of deals. If you try to force borrowers into the wrong situation because of your comp, you just lose deals. So we don't try to predetermine one over the other. But yeah, we're able to assist in a variety of different ways. The process really is simple. Again, you call for a soft quote. We talk on the phone for a couple minutes. We'll tell you what to gather. We'll send you out an application packet and a checklist. You get it in. A couple days later, you've got a letter of interest and a conditional approval. We go from there, and the borrower signs it. If you can get them to sign that, we're off and running. And 30 days, 45 days later, whatever it may be, we close the loan fund. We pay you directly, and that's the process in a nutshell.
Wonderful. Thank you. We have lots of good questions coming in, and again, please feel free to stay as long as you need, and we'll see how long Joe's energy stays up. Good question from David here. It says, if we are a licensed MLO employed by a company and our company is not signed up with M5 funding, how do we get paid, or does our company have to sign up with M5?
Well, that, again, is a great question, and I want to preface this by saying that I am not giving legal advice, and I'm not even going to give ethical advice in a case like this. In other words, I'm not going to advise you on your ethics. I don't presume to do that because you have to do what you feel is right, what is appropriate. I will only say to you that the vast majority of loans that we get from NMLS licensed LOs, we pay directly to those loan officers because their companies don't do commercial. So when we cut that compensation check, they fill out a W-9, they tell us where they want it to be paid, we pay it there. And there isn't any kind of a legal issue with that as far as we're concerned. I think that because of the unregulated nature of the commercial business, it's almost akin to if you had a side business, brokering rare flowers. It's not even related to what you're doing in terms of regs and licensing and so forth. So I can't advise you personally specifically, but I can only say that I'm talking like way up into the 90s percentile. We just pay folks directly, not through their companies. But we also do deal with a number of companies that have set up arrangements with us that their loan officers send us deals. The comp goes to the company takes their split. So we do it both ways. It's really up to the people that we're dealing with and their own decision on that matter.
Thank you. And I am trying to look at all the questions that have come in to kind of summarize them, Joe. So let's see if we can, this is a good question that came in from David. And let me make sure I get the right name on this one. In fact, it's a question from Bill. Do you also do commercial loans to companies that build apartments and then convert them into construction investment type of loans for the long term?
Okay, let me see if I understand the question. Okay, so we pretty much, let me just explain about construction loans and about M5 and our secondary market. So the loans that we do are all within the realm of typically the kinds of deals that there is a secondary market for. Term loans, perm type loans. So construction loans generally do not fall into that category. And the reason is that they're very, very short term. They're only on the books for 6 months, a year, what have you, and they're paid off. So there's no secondary market out there purchasing those kinds of loans. Those loans are made by local banks and so forth, and they love them because they're able to charge fees and turn their money and make good fee income. My long experience with this has been if I try to do a construction loan and tack my fee on top of a bank's fee, I might as well not even start the deal in the first place because I then become the actual reason that the loan fails. I become an extra cost in the deal. There's no value perceived there. I've stopped doing this years ago. I just don't do straight construction, which means I don't do deals like, for example, someone's going to build a bunch of condos for resale or a bunch of townhomes for resale, subdivision or whatever. I don't get involved in those. The exception may be if it's a hard money deal, then I will do it because, again, now there's a value being brought there. They've been turned down by everybody else, and so there's something that I can do that's different. However, we do construction loans as an accommodation. So, for example, let's say we are doing a permanent SBA long-term loan for somebody. I've got a guy right now that's building an office building. It's an insurance agency. He's got a bunch of employees, and they want to construct a new building. So we get the perm loan approved. We go and arrange the construction financing as an accommodation. Don't necessarily get paid anything on that. But when that construction is done and the perm loan funds, I get paid, and I do the deal for the sake of getting paid on the perm loan. So we will do that, but generally not for compensation. And we don't generally do projects for resale and so forth because there's no secondary market for those loans. So I'm not saying those aren't doable deals, but my experience is that any type of loan where you have to put your compensation as an added-on cost in the transaction is bound to fail in the end. So hopefully that helps.
Thank you. I'm going to put, there's two series of questions that keep coming up, and I'm going to blend them, Joe. And essentially the question says, how do we get from M5 specifically paperwork, how do we start, who do we contact, just so we know what the matrix looks like, what the forms look like. And then related to that, everyone also wants to kind of ask, how do we get protected from the point that we submit? How do I make sure that I'm safe?
Okay. Great question. So let me answer the latter one first. We have a mutual non-circumvention, non-disclosure agreement. Whenever you contact us on a deal, one of the first things we do is send that out as soon as we're looking at something. And you sign that, we sign that, and that says that we mutually agree not to circumvent each other, and we also agree to some other protections. So that is something that is designed to protect you as much, if not more, than it's designed to protect us, because quite frankly, a lot of the lenders that we do business with, if you were to go to them even directly, I mean, I can give you a name right here on the line. If you were to go to Zion's National Real Estate Group, unless you have $1 million tangible net worth in your company, $2 million of funding capacity for commercial loans at your discretion, and also have a volume of commercial loans that you've done in the last 12 months, they won't even give you the time of day. So, you know, the mutual non-circumvention, non-disclosure agreement is actually probably more designed for your protection than ours, but it's really for both, and it's written for both. So that's how we protect you. We also collect a 1099 from you right at the beginning so we can pay you where you want to be paid. And then I guess the other part of that, we have our website at m5funding.com. That's just the letter M, number 5, funding.com. And on the rates page, there's some matrices there. On the forms page, we have a variety of different forms there for download. I just want to tell you, though, that the rates and matrices are only representative. They're not at all comprehensive. Unfortunately, we just have so many different products and programs. There's no way we can maintain all of that on an external site. But so the best way to get that information is to start there, get your hands on what we do have, and then just pick up the phone and give us a call. Introduce yourself. You can talk to myself. You can talk to Andrew Terry, to Russell Hatch, to Jason Hall, any one of us, and we can help you. We can get you information. We can give you quotes and so forth.
Super. And related to this, I'm sorry, but Sharon asked a good question. If my client goes straight to you for a new loan project after we have started the sequence, am I still protected?
And yes, you are. And that's why we have that mutual non-circumvention, non-disclosure agreement, so that you can feel comfortable that we're not allowed to deal with your client without your permission and involvement going forward. So, yeah, let me just say this. Put yourself in our shoes. I'm going to say, 90% of our business comes from referral, and a big chunk of that comes from mortgage brokers, and the rest comes from bankers or real estate brokers. And even some of the bankers and real estate brokers are getting paid by us for bringing us these transactions. It is in our best interest to protect you because that's where our business is coming from. We are not looking at a short-term gain to lose a long-term relationship. We're just as interested in a long-term protected relationship as you are, more so because that way you're going to bring us deal after deal after deal. So that's, we do have those protections in place, and you will get paid on future transactions, and there's good reason for that.
Thank you. And we're going to start winding this down only because we've taken up a lot of your time as well. There's still many of you still online, but I'm going to ask maybe 2 more questions. And one very practical question came in, and appraisals have always been a stumbling block for me, says Rick. How much are they running these days?
Okay, well, commercial appraisals really do vary from one market to another and even from one property type to another, but typically speaking, you're talking anywhere in a range of about $1,200 to $1,500 on the low side for a commercial MAI appraisal to as much as even $3,500 or even a little bit more on some really larger properties. But pretty typically it's in the $1,500 to $2,500 range for a commercial appraisal. The good news about that, though, is that if you're doing this process the way that you should be, you already have a conditional loan approval before you collect for an appraisal from a borrower. They already know their terms. They've got an LOI. The details are all spelled out. The costs are spelled out. They know what the process is going to be. So, you know, it's not that hard to collect for something like that in that kind of a case. We just don't have any kind of resistance with that, but it's because we have approvals before we collect for the appraisal.
Thank you. And ultimately, as I've looked through all of these questions, I think we've answered the majority of them. And many of you have expressed interest in the coaching. So, Joe, you're going to be a busy man. We've got to figure out how to handle everyone's needs here. But at this point, we're going to end this webinar, if that's okay with you, Joe. Thank you so much for a fantastic presentation. For all of you who have joined us, thank you. And we look forward to, and you shall be receiving emails from Joe. In fact, the subject heading will always say, from Joe, and whatever the subject heading is. Look forward to that on the 3 items, the recorded webinar, you'll get that, the free ebook, and then there'll be follow-up contacts. Many of you expressed personal contacts. We will be getting a hold of you, and then Joe and his team will be contacting each of you for your one-on-one sessions after we've tallied up everybody's interests. Joe, any parting comments?
No, just to say thank you very much for being on with us today, and really appreciate your interest and your great questions. Look forward to talking to many of you.
Thank you, everyone. Thanks for joining M5 and Joe Mardesich. This is now the end of the webinar. We look forward to communicating with you still, and great success in your future. Take care. Bye-bye.